Good morning everyone, welcome to the Mango Monkey Show. In this video I will be talking about lender's mortgage insurance, commonly known as LMI. What is lender's mortgage insurance? Well, lender's mortgage insurance is where if your deposit when you buy a property is less than 20%, the bank will want to pass on some of the risk to an insurance company. The insurance company will then pay the bank if you do not pay your loan, and the sale price of your property when it is sold by the bank is less than the balance of the home loan. Okay, so when else would you need to pay lender's mortgage insurance? It could also be when your deposit is 20%, however, the value of the property is actually less than the price that you paid for the property. This can happen, for example, in a tall apartment building like the one behind me, where there may be a lot of owners who are selling the property for a cheaper price than a normal market value. So when the valuation company looks at the value of the apartment unit, they normally look at recent sales. So if in recent times there have been a few distressed sellers who, for example, need to sell because their tenants are not paying and the banks are hassling them to get rid of the apartment unit, the valuation of the apartment may be lower, even though it doesn't necessarily reflect the long-term market value. How much is a lender's mortgage insurance? It depends on the deposit that you have and how much is the loan compared to the property value. It also depends on the dollar amount of the loan itself. Normally, the bigger the loan, the bigger the lender's insurance premium. For a typical first-home buyer who contributes around 5% of the property value in cash deposit, the LMI insurance premium is typically roughly 3% of the property value. When the deposit is around 8%, the LMI premium is usually less than 3%, but slightly above 2% of the property value. Now, if let's say the deposit is 10%, normally the LMI is under 2% of the property value. LMI also depends on the insurance company. The two biggest insurance companies in Australia are QBE and also Genworth. There's also one more which is called Arch Capital, which is used by a small number of banks. Some banks also self-insure. What this means is that the bank insures the mortgage himself. They essentially charge a fee and have certain policies that needs to be satisfied for the home loan to be approved with a smaller than 20% deposit. Now, it is important to note that the lender's mortgage insurance protects the bank. It does not protect you. So what that means is if you lose your job, the insurance will not actually pay your mortgage. You will still need to pay your mortgage with your own money. But if the bank needs to sell your property and the sale price is less than the balance of your home loan, the insurance company will pay the bank the difference. So question of the day, is it a good idea to buy a property with lender's mortgage insurance? Or is it better if you save up a bit more so that you do not need to pay the lender's mortgage insurance when you actually buy your first home or second home? Well, I think in my opinion, for your first home it's okay to pay for the lender's mortgage insurance. The reason is if you do not want to pay for the lender's mortgage insurance, you will need to save 20% deposit. Imagine how many years it takes for you to save that much money. If your property is $500,000, you need to save $100,000. That will take you probably, I don't know, maybe 10 years. By that time you'll be 30. Everyone else, all your friends will already have their first home. You will be too late. And the property price will be double already. So get started early. That's I think how you can build a bigger portfolio. So what kind of extra things do you need to meet if you want to buy your home with lender's mortgage insurance? Well, it really depends on the bank, but some banks need you to not be on probation in your employment. So if you have just started a new job and it's still under probation, a lot of the times you cannot buy a home with lender's mortgage insurance because the insurance company does not like you. Sometimes also if you have a casual job, you have to be in the job for at least 6 months. Depending exactly on the insurance company and the bank. Some banks can follow their own policy, so even though the insurance company does not like you to be in a casual job, if the bank has their own approval authority, they are able to approve your loan. Even though if you were to go to a different bank and the insurance company is the same, the loan will be declined. They also look at your property, the property that you're buying. A lot of the times your home has to have a certain size. For example, the internal area, which for some banks exclude the balcony and car space, must be more than or equal to 50 square meters. Just remember that different banks have different definitions. So for example, if one bank excludes balcony, it doesn't mean that the next bank will also exclude balcony when they calculate how big the size of the property is. Some insurance companies also have certain postcode restrictions. The Sydney CBD may be on a bit of a blacklist with certain insurance companies. They may be a bit more picky with the properties that you buy if it is in the Sydney CBD. So how do you know whether a property is okay or not for the insurance company? Well, most of the time you do not know. That's why it is important to buy with a cooling off period if you do not have 20% deposit. If you buy with a cooling off period, if there are issues, you lose only a little bit of deposit. In New South Wales, you only lose 0.25% of the purchase price. So that is normally around $1,000 or $2,000, very small. Now, just like buying an insurance for your vehicle, different insurance companies have different prices. Sometimes it may be cheaper to go with a certain insurance company compared to another one. However, each bank normally uses only one insurance company. So what that means is that if you want the cheapest or the cheaper insurance, sometimes you have to go with a bank that may not be the best fit for you. They may not give you the loan because of certain situations that you have, or perhaps they give you a smaller loan compared to a different bank. So what I recommend is that for your first home, you cannot be too picky, and you can buy the biggest home that your bank has approved you for, even though it is not the cheapest home loan and the cheapest home loan insurance premium. Good luck with your home purchase, and don't forget to subscribe and like this video if you gain something from it.